What if I told you that there's a stock you probably already know, it's a household name, that most investors seem to be overlooking right now? Almost like it's hiding in plain sight while everyone chases all these hot AI stocks. In fact, let me just show you exactly what I'm talking about and why there's massive potential to make a ton of money here. It's rare to find a stock that checks every single box: strong business, steady profits, and selling below what it's actually worth. This one we're looking at right now has massive potential. Most investors are chasing overpriced names, but the real money is made buying great companies before everyone else sees the value while they're down. And this stock could be that opportunity. We are not here to chase hype. We're not meme stock bandwagoners or Reddit speculators. We're here to look at real companies, real cash flow, and real opportunities. And today, this one is very interesting. This isn't a chip stock. It's not AI hype. It's an amazing brand quietly scaling into international markets with real revenue and real growth. The crazy thing is, the stock is down 37% in the last 6 months alone because the market seems to be overreacting to every news story. We're asking the only question that matters in investing. Is the stock selling at a great price? Which means it's selling below its value. Now, let me ask you this. Would you pay $60 for a $100 bill? Of course you would. That's value investing. We're just trying to get the same deal that everyone in the world would brag about if they went to the store or went to the car dealership and found their favorite item on sale. Great companies do go on sale all the time. Not because they're bad businesses, but because the market's emotional, impatient, or just plain wrong. Warren Buffett has always said, price is what you pay, value is what you get. And that's the game. Ignore the noise. Look at the business. Does it make money? What's its growth like? Does it have real value? If the answer is yes, and the price is below that real value, you should probably pounce. Buffett did not get rich chasing hype. He got rich by buying great businesses when no one else was paying attention. A lot of times he bought great businesses when they were temporarily out of favor. This isn't about gambling on the next hot trend. It's about buying $1 for less than $1, 60, 70, 80 cents, and being patient enough to let the world catch up and let the compounding continue. That's how Buffett built his empire. That's how real wealth is built. One undervalued stock at a time. Keep in mind, I'm not telling you have to be like Buffett. I am telling you should think like Buffett. So, what's the stock we're talking about? Lululemon. Yes, the yoga pants company. But we're going to look at it from an investor's point of view. The stock has dropped significantly hard. North America, their home turf is slowing down. Tariffs ate into their profits, about $240 million worth of a haircut. Not only that, guys, the consumer out there seems a little bit weaker. And when the consumer is weaker, are they more or less likely to go buy $100 plus yoga pants? I think that's pretty obvious. So what does that mean? People are panicking. But here's the part that gets me excited as a value investor. Lululemon appears to finally be cheap. Not cheap like poor quality, cheap as in less expensive, like it's on sale. The company's still making money and growing, still has great margins, and their overseas growth is crazy. China, boom. Europe, boom. People love this brand, and internationally, it is just getting started. So let's talk about the numbers. Lululemon Stock was trading at an all-time high in December of 2023 of $516 per share. It's currently at $177 per share. In fact, it got as low as $159 on September 15th. This is the chart here. Yeah, don't look at a chart to say if it's a good buy or not. As the stock was running up, it'd been hard to sit there and say, yeah, the stock's going to fall 60, 70%. But right now, Lululemon is trading at a much lower price. And you'll sit there and see me say that you shouldn't follow price to believe you're right or wrong. But when a stock like this has fallen so much, you got to at least pay attention and try to find out why. Guys, even their own management is buying back shares. Why? Well, a smart management team will only buy back shares if the stock's undervalued. But more importantly, they weren't buying back shares here. They're buying back shares here. That tells me that management gets it a little bit. Now, guys, this is really important to hear out. You're very lucky to have found this video, and I don't mean that in an arrogant way. Nobody on YouTube talks about investing this way, but they need to be doing that. It's no surprise that Monish Prabrai watched our videos and said very admirable things about us to even allow us to come to his office and interview him directly. He sat there and said, you guys get it. Now, when it comes to Lululemon, there are risks. Competition is tough. Their price is very high for their products. The economy continues to slow, then people will probably pick cheaper brands. But if you're patient, if you understand that things go in cycles and every stock is the present value of all its future cash flows, as long as you believe in Lululemon for the long run, it might be a great opportunity. It might just be that rare, undervalued gem hiding behind a pile of investor fear. And the moral of the story, you buy great companies at great prices. Lululemon might be one of them, but we need to analyze it first. So let's take a look at these numbers. First off, one of the things I want to show you to prove its greatness, return on capital. All in all, this number will tell you, is this a good brand? Is this a good company or not? When it's over 10, 15%, you know it's a good company. It just means they're able to reinvest money back in the business and get high returns. 2, one thing I don't like about this company, their free cash flow is lower than net income. You have to understand why that is. Now, this is one of the most highly voted on stocks by our community members. Our community members have it as a buy. And if you're in the community, don't forget that these votes only last for 6 months. You have to go, because obviously we don't want a buy vote from 3 years ago to still be in the data. And guys, for those of you in our community, we have something exciting here. In this circle coming soon will be everybody's vote for their intrinsic value of the company. Not just Lululemon, every company out there. So you'll be able to sit there and say, okay, what does the average community member give as the value to the business? Now, what is exciting? It's selling for 11 times profit. Now, you're probably like, well, Paul, if you've seen our videos in the past, Paul, you hate it when cash flow is lower than net income. Absolutely. I don't like that. I will say, though, Lululemon's a growing brand, and they have to go expand their production and things like that. So I have to understand how much of this cash flow difference is because of growth. That's a really important thing to understand. But one thing I love about Lulu, their gross margin is almost 60%. That means every product they sell, 60 cents of it is basically profit for them. That's incredible. Now, guys, there are lots of stocks that have massive growth potential. In our title here, I don't want you to take it literally. I want you to say, like, listen, this is a very popular stock that has a lot of growth potential. Lululemon is a very well-known brand. The vast majority of our viewers are male, but for the female ones, you know what I'm talking about. And for the male ones who have wives, girlfriends, or friends that are ladies, you know how popular this brand is. It's extremely popular. Even guys I know love wearing Lululemon. Mo, our channel cohort, he loves Lululemon. Now, let's go take a look at our 8 pillars here. Wow, 8-pillar thriller, guys. All 8 pillars are check mark. This doesn't mean you go buy the stock. It's just telling you a story here. Revenue growth, $7 billion. Net income grew $1.25 billion over the last 5 years. And cash flow grew $740 million. So as you can tell, cash flow grows slower than net income. High returns on capital, low multiples, buying back shares. But this one I love. Very low debt. This says that based on their average free cash for the last 5 years, they could pay off their debt in the next 1.5 years. That's a company that has staying power, guys. Now, if you're new to the channel, if you're new to investing, this can be overwhelming. You're not alone. Everybody at some point in their life was overwhelmed by the numbers. I was, you were, Warren Buffett was. The key is everybody here watching this video, your goal should be to get better at thinking about money, to get a little bit better investing, to increase your investing game. That's it. If you do that every single day, every single week, every single month, even if it's 1% each time, you will be a totally different person very soon. Now, I went over these key metrics, some of them. There's a lot more here that are very important. As you watch our videos, you need to understand these. I want us all speaking the same language. So if you want the shortcut, if you want a way that you can have all these right here, click the link below. There's a free PDF. Put your email in there. We'll send it to you within 1 or 2 minutes. You'll have the explanation for all of these, why they're important, etc., why I look at them. I want us all speaking the same language, rowing in the same direction. And this is exactly why I teach on YouTube. I love teaching in general. I love talking about investing. This is a way it keeps me in check, but also I love to have us all speaking the same language and talking about things the same way. Now, most investors are going to lose money because they're trying to pick massive winners. The best investors do the opposite. That's why I sit here and talk about this debt level. It's hard for companies to go under when debt is low. And that's what good investors do. They eliminate the losers first. And one of the first places to go to find a loser, do they have a lot of debt? And are they selling for a huge multiple to cash flow or earnings? This is where I focus my attention on. Because just like you personally, if you have very little debt, the likelihood of you going bankrupt is probably very low. And if you're going to make investments, the less you pay for those investments, the better you will do. Now, in a couple of minutes, we're going to go over what I'd pay for Lululemon stock and my assumptions about it. But let's see what these analysts think about Lululemon. So what's interesting is the analysts see growth here. 1462, actually for the next year, 1478 growing to 2383. All over the board in terms of their growth, but there might be some slowdown here. But let's look at revenue. Here's what's interesting. 6%, 7%, 5.5%, 10.5%, 7.2%. So I talked about a lot of growth potential. What I mean by that is if you can pay a low price, you can get a lot of growth in your investment. This company is growing, but this isn't like shockingly high numbers. So are analysts right? Am I right? Are people out there right? We don't know. All we know is what I do know about Lululemon, they're a strong brand, they're a quality brand, and they sell for a premium. The question is, will they last the test of time or will it be another fad? Now, we have stories, we have numbers. How do we put them together? Very simply, guys, the stock analyzer tool. Now, when it comes to stock analyzer tool, our goal here is to put the story and the numbers together to give us an idea of if we even waste any more time. I always hear people saying like, oh, the story's so good, fall in love with the story. No, go to the numbers first. If a stock is worth $100 to you and it's selling for $1,000, why are you going to waste any more time? There's a reason why this thing is used over 1 million times per year by our users, because it's a great way of filtering out junk. I don't want you going out there and chasing a name and chasing a story. I want you saving your time to research the things that make the most sense. Let's say Lululemon is at 177. Let's say stock analyzer says it's worth 500. Go do the work. Go do the work because it's selling far below its value. But if it says it's worth $10, why are you even wasting your time? Don't do it. It's at 177. It's worth 10 to you. Double it. It's still only worth 20 to you. Go move on to something else. So I'm going to start my stock analyzer here. So first off, we have that growing returns on capital. Okay. That means the company keeps getting better when they have money invested in the business. Revenue growth, I did 4%, 7%, and 10% over the next 10 years. Profit margin, 14, 15, and 16, and free cash flow, 13, 14, and 15. Now, with 60% gross margin, like I said before, this number should go higher and higher as time goes on. So this might be conservative. But if they have a slowdown, maybe their gross margin decreases. We don't know exactly. Now, what PE would I assign to this business 10 years from now? Guys, this tells me it's a premium company. And if the market average is 15 or 16, based on this, I should say it's higher. So I'm going to sit there. I don't know why 14, 17, and 20 is in here. I'm going to call it 16, 19, and 22. Now, you might sit there and say, well, Paul, I don't like retail. I get it. But that's where you put your margin of safety in here. I'm only putting 9% in here because I want to know what's this company worth? What's the intrinsic value? What is it worth if I were to match the market? That's where I'm looking at for 9 or 10%. But if you want your margin of safety, you got to put a much higher number in here. How much higher? It's up to you. Some people would say 12, some people would say 20. It all depends on how much cash you have, how badly you want the stock, things like that. Now, guys, 25 years ago, I would have chased Lulu as it's going up all the way to 500. I never looked at the numbers. And then when it started to fall, I would have sold it thinking to myself, oh, this thing's a dud. I would have never understood the fundamentals. But that's not investing. That's gambling. And that's exactly why I created Everything Money. I wanted 15, 20-year-old Paul to have the tools, strategy, and community that I never, ever had. So when you join Everything Money, you're not just getting our investing software, this obviously awesome stock analyzer tool, you're getting a foundation. And you're getting a foundation around people who are like-minded. Remember, you're going to be the same as the 5 people you spend the most time with. Well, how about the thousands of people you spend the most time with? That's the key here. If you want to think this way, if you want to level up your investing, you got to be around the right people. You have to set up the right mindset and have the right tools and support along the way. So if you're committed to learning how to invest the right way, not chasing, not looking for a shortcut, Start your 7-day trial today. Click the link below. We limit the spots every day. So if you're serious, I'll see you in the community. I repeat, if you're serious, this is the moment, because we don't want people who are just looking for shortcuts. We want people who are lifelong learners. So I hit the analyze button here. The stock's at 177. Well, guys, this is why I think it deserves some attention. 200 to 220 on the low side, 460 to 480 on the high side, 300 to 320 in the middle. That means if my middle assumptions occur and I pay 177 today, it's a 16.76% annualized return based on discounted cash flow. Guys, that's pretty solid. That's why I said it deserves attention. Now listen, guys, before we go any further, I need to share something with you that's absolutely foundational to how I invest. If you don't understand this, you don't understand value investing, and it's the reason most investors lose money. It's the difference between price and value. Price is what you pay, value is what you get. Warren Buffett said this line. I think every investor should memorize it. What does it mean? Price is just the sticker. Value is actually the worth of what you're buying. They're not the same thing. I want you to go to a car dealership and buy a car for $40,000, knowing that there's $100,000 worth of gold in the back trunk that nobody's opened the back trunk to see. That's what I want you doing. So remember, when you're looking at stocks, don't obsess over the flashing number on your screen. Ask yourself, what's the real value of this business? If you can buy $1 for a lot less, like 60, 70 cents, you're in Buffett territory. If you're paying $2 for $1, you're just a speculator hoping to get lucky. Now, I want you guys to remember, somebody out there is watching this saying, yeah, but Paul, not all companies are the same. You're right. That's exactly right. Valuing the company is the hard part because it's an art. Two companies are exactly the same, but one has a different growth. They have different growth rates, are valued very different. Because remember, every investment is the present value of all the cash flows in the future. So if the cash flows in the future from company A are going to be far greater than company B, it should be valued more. That's why I laugh when people say growth investing and value investing are different. No, they're not. In fact, in our stock analyzer tool, the very first line it asks you to input is revenue growth, the growth part of the business. That's what matters. If two companies are exactly the same, one's going to grow 20% a year, one at 5% a year, the 20% a year company deserves a higher value. You should pay more. But remember, this is the kicker. If you don't know how the company is going to make money, you will not be able to tell whether the price drop is just noise or a real problem. And that's why people panic. They only see the falling price, not the value increasing or holding steady. So your job as an investor is quite simple, but it's not easy. Ignore the flashing numbers and figure out what the business is really worth. Do the research. Put in a stock analyzer tool. It'll tell you what price to pay based on your assumption. And if the price falls far below enough to the value, congratulations, you've probably found a deal. But if the price shoots way above that, you don't need to be a buyer. You can sit in your hands doing nothing. Price is what you pay, value is what you get. Never confuse those two things. Now, this principle-driven investing approach, these 5 tenets, these are what keep me from getting sucked into the noise. Instead of panicking over every price move, as I said before, I stay focused on the only thing that matters, the difference between price and value. And that's why principle-driven investing matters so much. It keeps me from falling into the emotional trap that ruins most investors. When prices swing wildly, emotions tell you to chase when it's high and panic when it's low. But principles remind me that the market is just an auction and the price isn't the same as value. And I've got to think about this long term. I think about a company going, what would it be like if 20 or 30 years from now, this company was gone? Now, for my companies that I buy, it makes a lot of sense. It really keeps me calm. By sticking to my process, I avoid making knee-jerk reactions. I don't care if the stock drops tomorrow because I know the value hasn't changed much. That discipline gives me confidence to sit still while others are freaking out. And don't get me wrong, guys. Most companies that fall have a reason for why they fell. The question is the fallen price justified by what went wrong? Now, these principles aren't about making you emotionless. Guys, we all have emotion. But they're about giving you the proper framework so that your decisions are based on logic, not fear, not greed. And that's how you stay focused on the only thing that matters in the long run, the gap between price and value. We want it this way. Value up here, price down here, not this way. Now, guys, these principle-driven investing tenets that I told you about, first one, We're investors, not speculators. Second, every investment is the present value of all future cash flows. Third, if we don't understand it, we don't buy it. That's probably one of the hardest ones because people want to sit there and see a stock go up and go, well, yeah, they do this. But if you don't understand the numbers, if you don't understand the justification, you don't buy it. Number 4, in the short run, stock market's a voting machine. In the long run, it's a weighing machine. And the 5th, and probably most important one, a great story can become a bad investment if you pay the wrong price. Now, everybody listening to this can probably agree with that. But in action, it's hard because a great story sounds so exciting. We all fall in love with a story. But here's the thing. Prices are never going to stop fluctuating. To the investor, this is a good thing. That's just the market being the market. But value, that's steady. And if you understand the difference, you're going to stop getting pushed around by the noise. Now, I think there's a time coming in the future when stocks will be a lot cheaper from a value standpoint. And that's exactly why you need to learn this skill right now. It's really important that you get this knowledge of principle-driven investing and the skill to value stocks before the market turns. You don't want to react. You want to be prepared. So in this next video, I'm going to show you how we prepare so that you're ready to act when the opportunity arrives. The video is linked right here on your screen, so don't miss it. This is how you put yourself in the best position potentially to get market-beating returns. Thank you for your time.